Assalamualaikum warahmatullahi wabarakatuh, and very good morning to everyone. Today I would like to discuss about Chapter 6 and Chapter 7, which are Mathematics of Finance and Working Capital Management. Alright, so we will go through by the definition. First, Mathematics of Finance is a branch of mathematics that is dealing with financial data, and it is available in a variety of business and vocations. Alright, we move on to the next slide. The financial mathematics includes, there are three things that you need to know, which are economics, statistics, and probability. So for the economic is to study how goods and services that are produced and consumed, including demand and supply. For the statistic is the study of data, including the analysis of data, and the probability is the mathematical word for the possibility for the event that will occurring. Alright, so who use the mathematics of finance? First, financial analysis, bankers, and data scientists. So I will start with the time value of money. So the definition is that the amount of money that is worth more now than it will be at the period. So in the time value of money, there are two, which are present value and future value. So what is present value? Present value is also known as the present discounted value, while the future value is the value of an asset at a future date. Alright, so next step is how to identify the present value or future value, which is single or annuity. So for the single is when the payment is one time only and the payment is made for every year, which is difference. While for the annuity, it must have two or more same amount for every year. And next step is how to identify the annuity is ordinary or due. So ordinary annuity is when the payment is made at the end of the period, which is 31 December, while the annuity due is the payment that made now or today or beginning of the period, which is 1st January. So let's look into the rules. If interest paid semi-annually, we have to divide by 2. If interest paid quarterly, we must divide by 4. And if the interest paid by monthly, we will divide by 12. Alright, in the Chapter 7, Working Capital Management, the definition is organizational that joint firm work efficiently and can be measured by using ratio analysis. Alright, in this slide, we can see that, for example, from the current asset of the company, turn into the cash, and cash by the inventories and sell to the customer, which is account receivable, and we will accept the cash from the customer. So as the formula, you can see in the slide, net working capital is equal to current asset minus current liabilities. So for the assumptions, when the current asset is high, the profitability will be lower and the liquidity will be higher. While for the current liability is higher, the profitability will be higher also, and the liquidity will be lower. Alright, in this slide, I will explain you about the implication of shortage and excess in working capital management. So in shortage, it will cause low production level and delay of payment, while in excess, it will be the defective credit policy and the low rate of ROI eventually will cause the market value of share will be fall. So there are three policies in the working capital management, which are relaxed policy, moderate policy, and restricted policy. In relaxed policy, it will have high liquidity but low profitability, while in the restricted policy, there has high profitability but low liquidity, while in the moderate policy, it has moderate risks and moderate return. Alright guys, in this slide, I will explain you about the approaches of working capital management. Yes, same, there are three approaches, which are maturity matching approach, aggressive approach, and conservative approach. So what is maturity matching approach? This strategy is process moderate risk and moderate return, while for the aggressive approach, the strategy process high risk and high return, and the conservative approach is process low risk and low return. Alright guys, that's all from me. Thank you.